Neil, can I start by asking, did you always want to be a fund manager, or was it something you landed into by accident?
Very much an accident. I didn't really know what fund management was about when I left university. Such was the theoretical focus of my university degree. So I didn't even know what the city did actually as well, I'm ashamed to say. So anyway, it was by a series of sort of luck, chance events that I ended up in a fund management business as a trainee. And I quickly found out this was something I really enjoyed doing, and a few years later I found out I was sort of half decent at it. So I was very lucky to end up in fund management.
A rumour has it one of the things that you contemplated doing beforehand was, I suppose, that the early years of private equity, 3i.
Yes, before I returned to the fund management, I started off in fund management as an analyst, and I felt that, as I think all fund managers should do, really, is appreciate that that there's an apprenticeship, as in there are in most professions. For me, the apprenticeship was all about understanding how the economy worked and how businesses worked, and I wanted, therefore, to learn as much about corporate analysis as I could. I spent some time in fund management and then came out of fund management briefly and worked for a big bank in the city on a sort of on a team that reported to the chief economist that was working on deploying the proceeds of an IPO. Anyway, that was a really interesting project. And when that came to an end, I was thinking about, well, what do I do then? And I have to say that the work I'd done whilst working for the bank was so interesting. We really got into the weeds of the businesses that we were thinking of acquiring. In a much more detailed way than I'd done as part of an investment management operation, and that really attracted me. So I did think about joining 3i, but of course I had to be a trained accountant to get a job at 3i. I wasn't a trained accountant, and by then I had no appetite really to subject myself to a whole load of more exams. So anyway, I decided against that and went back into fund management, and I suppose the rest is history.
Yeah, right. Well, look, the three really distinct things about your time, particularly with Invesco Perpetual, I think almost everyone can read three particular things about you. Firstly, a willingness to look at earlier stage businesses than some others would do. Secondly, a real fascination and a confidence in UK science and its commercial applications. And thirdly, an almost sort of religious focus on the long term. Now, it's often said in the UK that all three of those things are slightly unfashionable in business circles. Taking the chance involved in early stage business. This seems to be a very arts biased country rather than a science focused one, and the long term seems to be about 20 minutes. So explain your religion in that sense, and how hard is it to push against a culture that actually seems to lean in the other direction?
Well, the first point to make is it is incredibly hard, and it's particularly hard. It's not consistently hard. It's always difficult to swim against the tide. Keynes said, didn't he, that it's better to fail conventionally than to succeed unconventionally. And having a fund management perspective, as he did, I think he was talking to the sort of problems that I've encountered in my career as doing things differently. So it is very hard, and has recently been particularly hard, actually. I think one of the reasons is, well, certainly my religious sort of zeal in this space is really driven by the same approach that governs my interest in businesses across my investment universe. I suppose what I do that is unusual is look at the entirety of my investment universe and look for opportunities across that spectrum. I think most people who do what I do exclude parts of that investment universe and only really focus on the things that other people are focusing on, the sort of well-worn path, if you like. And I think there are all sorts of cultural and sort of structural reasons why fund managers huddle around a sort of consensus. Anyway, my approach to early stage, my initial interest was driven by the fact that it's a legitimate part of my investment universe. So I felt that I had to be as informed about early stage scientific disruptive businesses as I had to be informed about BP or Barclays Bank. Having delved into this particular universe, I began to find what I still believe to be the most inefficiently priced asset class that I've ever come across.
Right.
And it still is, frankly.
Explain why.
Well, it is inefficiently priced because so few investors want to play in that space. There are some other non-correlated asset classes that I think have interested me along the way. And one, for example, that's emerged in recent years is litigation finance. It's another interesting and inefficiently priced asset class where returns are very high. But I think this is definitely the case for me in that early stage, quoted or unquoted arena. And it is precisely because there are so few providers of capital in that space. So, venture capitalists are in a part of that universe, but the bit that I play most actively in, and which is the bit I think where there is the most acute shortage of capital, is in the scale-up piece, and it is in that universe that there are literally one or two players who are prepared to put patient capital to work to facilitate the scale up that knowledge intensive and capital intensive businesses need to get to where they can get to and should be getting to. And it's inefficiently priced because the supply of capital is way below what it should be, but the demand for capital is huge. And that always creates inefficiency. By inefficiency, I mean very low valuations, essentially.
Right. Yeah. Now, on that sort of long-termism question you alluded to, I mean, there seems to be quite a consensus for quite a long time in Britain that we have a problem with a short-termist culture. And equally, for quite a long time, not much has been done about it. What do you think it is about the UK in particular that seems to fuel either a bias towards the short term or a resistance to the long term, which way you put it? Is it cultural? Is it the way that the city is organised? Is it the way that financial incentives operate? I mean, you're a very internationally travelled observer. What is it you think that has made this country different and less appealing in that respect?
I've spent a lot of time thinking about this, and I don't think we've got long enough to sort of unravel all of the issues, but I think that they are many and varied, and they've built up over a long period of time. Through most of my career, I've witnessed a series of events that have compounded this move towards an increasingly short-term agenda. And variously they are regulation, for example, and that sort of regulatory tide started to move in the direction that it continues to move in post Robert Maxwell falling off the back of his boat and having run off with his pension assets. That's one issue, I think, that has, the law of unintended consequences, the motivation to protect pensioners has resulted in all sorts of unintended consequences which have driven the natural long-term patient capital owners of the sorts of businesses we're talking about out of that asset class. The reward structures around fund management, for most fund managers, taking a long-term bet, doing something out of the ordinary encompasses too much career and remuneration risk. Because they are remunerated and rewarded and promoted based on relatively short-term measures. Of course, the fund management businesses that employ the fund managers equally have short-term, particularly when they're public businesses, have short-term reporting criteria. They can't afford their fund managers to do things that are different, that result in underperformance, that then results in low market share of sales, for example. There are lots of contributory factors. The regulation has a key part to play. I've alluded to that already with respect to pensions, but I think the increasing layers of regulation that have scared people away from this asset class have played a role as well. Lots of factors. Lots of fund managers. The way assets get allocated is to some extent a product not just of what fund managers want to do or the fund management businesses that employ them, but of course the consultants have a role to play. So there is these multiple layers that have aggregated in a particular direction, and they have bit by bit pushed my industry further and further away from a long-term patient capital approach and more towards a short-term sort of consensual approach that huddles around big liquid equity investments.
So it's a partially accidental but partially deliberate,
yes,
informal conspiracy in effect.
I don't think anybody's been managing. There isn't a sort of a single body that has pushed us in that direction. I just think we have unwittingly and almost by accident inexorably moved towards this short-term agenda, and I think we've ended up in a very, very worrying place, frankly, where I think there is clearly market failure.
Right. Now, you've very kindly volunteered your time, amongst many other things, towards the government's patient capital review, part of the panel, which is sort of operating alongside the Treasury, looking at this whole space. The submissions are now in. Obviously, you're not in a position to reveal the Chancellor's budget on November 22nd, but if you would like to do so, that would be fine. But are you an optimist or a pessimist that actually the right questions are being asked and the right answers are being looked at now?
The short answer is yes, I am. I'm more optimistic now than I have been for a very, very long time. I've, over numerous occasions over the last 10 years, been involved in various meetings and consultations, which have gone nowhere. I have been banging the door on this problem of market failure for a long, long time. But I really get the sense now that the government is listening and has finally accepted that the market is failing. And there is equally an acceptance that if the market's failing, then the government needs to do something to sort of correct that market failure. Because it is very clear that the economy is being damaged, not just today, but I think the future of the economy is being damaged by this market failure. I think there's a clear now and wide recognition that our failure to scale our great scientific leadership into scaled scientific, knowledge-intensive, typically capital-intensive businesses that employ lots of people, that provide highly skilled jobs for our graduates, that pay tax and increase the wealth of the nation. These businesses, we're not creating them. We're great at creating lots of little businesses, which either stay little or get sold to the Japanese, the Europeans, or the Americans who have the capacity to scale these businesses. But it really, really is important that we scale them here. If we are going to create the wealth that we need to in the future, create the jobs and the enterprise that we need to in the future, we're going to have to make a success of our knowledge economy. And I'm so pleased now that message has got through. And for the first time now, I think the Patient Capital Review has really sort of galvanized all of those opinions, if you like, into one unified set of recommendations, which I believe to be very, very helpful. And we've got a sympathetic audience. So I'm very hopeful that something will happen, and maybe happen in the budget. I'm sort of got my fingers crossed.
Now, you put your money where your mouth is in more ways than one. 3 years ago, you set up Woodford Patient Capital Trust. You didn't need to. You could have just had a large house in the Cotswolds and a beach bar in the Caribbean. There's no obligation to do it. What made you choose to do it? What did you think was missing, both in terms of the market and in terms of the structure of an entity? What's different about the WPCT as an entity, the way you organise yourself, than perhaps parts of your past life in fund management?
Well, you're right. I mean, the decision, my business partner and I decided to set Woodford up, principally because I think we had the time and the opportunity to take a step back and think about what the fund management industry was doing wrong. And I think we approached this challenge or this problem, this opportunity, by thinking, well, if you were going to start a fund management business today, and a business that would be fit for the 21st century, would it look like any of the incumbents that exist and that I'd worked for 26 years? And I think the very clear answer to that was it wouldn't look anything like them. It would be very different. And I suppose we had the naive optimism to say, well, if it wouldn't look anything like that, let's build a business that is fit for the 21st century, that will operate appropriately, that will be open and transparent, that will have low cost, that will do things differently, and let's have a go at it. Now, it wasn't easy at all. The regulatory hurdles, the other hurdles that were put in our way were pretty substantial, but we got over them, and I think we have been, over the last 3 and a bit years, true to that sort of founding principle. We wanted to do things differently. We wanted to do things that would just shake the industry for the sake of it, but do the right thing for the client base. So be open and transparent, have a low cost, pass those low costs on to our customers, have a different remuneration structure, lots of things like that. Pay for research in the way that we do. So we did a lot of things differently. We sort of were a bit iconoclastic about a load of things, and I'm sure that we're not particularly popular as a business in our industry, but I think we're doing things the right way. Anyway, and then of course, what creating that business enabled me to do was to really deliver on my passionate belief in the opportunity set in early stage businesses. And that's why we launched the Patient Capital Investment Trust, to focus exclusively on this asset class and to provide a vehicle that retail investors could invest in that would give them the exposure to this wonderfully undervalued and incredibly exciting asset class that I believe will deliver outstanding returns and for our investors, but equally, we can do some good in the process as well.
Well, I suppose one of the challenges of being a sort of prophet of the long term is not only do we have to live through an awful lot of short terms to get to the long term, there's not necessarily a consensus as to exactly when the long term is. So if a prospective investor came into you and said, "Okay, Neil, I'm in it for the long term. Can you give me a clue as to how long that is?" How does that conversation go from there?
Well, it's been very hard. I mean, we deliberately set out an agenda that was explicitly long term. The clue's in the name, but of course, because we weren't able to deliver outstanding short term returns, we've had quite a lot of mud thrown at us. But those of you who are industry practitioners will know that building value in this industry in early stage businesses is a patient exercise. It takes time. You don't get rich quick, really, in this business. We're in the business of getting rich slowly. We believe that 3 to 5 years is the sort of the first milestone, if you like, against which we should be judged. So what I've said to our investors at the start of the launch of the vehicle was, put your money into this vehicle. We think it's an incredibly exciting opportunity. It's an incredibly undervalued asset class, the likes of which you've never really seen. You have never heard of any of these businesses. You've probably had no exposure to them in the past, but we think this as an asset class, this asset class has an appropriate place in your portfolio. But when you put money to work in this space, take your time and judge us, if you like, from the first 3 to 5 years. But think of your returns as being longer term than that. So really, you should think about the 5 to 10 year time frame. So 3 to 5 years is still short term in my view, yeah. But we were sufficiently excited about what we could achieve in the relatively near term, which I would say is 3 to 5 years, that we said, okay, judge us on that basis. But really, if you are giving this the opportunity that you should be thinking about the 5 to 10 year return.
Now, life sciences has been a very important part of your pitch. And again, it's an area where there's been this concern that the UK has not really devoted the love as much as anything else, the time, the money, the love in the past as it should have done. Do you see the UK changing in that respect? I
do. Yes, I'm getting quite excited about. I mean, for many, many years, the UK has done life sciences probably better pound for pound than any other country in the world. California and Boston, are two very highly regarded centres for creativity in that industry. But I think, Oxford, Cambridge, London, and other universities around the country in the UK, have excelled in this space for years. It's probably our best kept secret. Oxford University is the world's leading life sciences university. Not many people seem to recognise that. And not only has it earned that reputation by being incredibly innovative and at the cutting edge of science for many, many years, it's getting more so now. I think the environment, so I'm close to Oxford, of course, because our business is based in Oxford and we have great relationships with the university. And I would say the environment now is as exciting as it has ever been. And there is a tangible sort of belief in the ability of businesses that are being spun out of those science departments at Oxford University. There is a genuine belief that we can, with a number of these companies, change the world. And I think it's a really exciting time to be involved. Now, the reason I'm sort of equally more optimistic than I've been for a long time is because that capital problem that I've talked about is in part, I hope, going to be addressed through what the government might encourage the industry to do, or might encourage the economy to do through an initiative. But equally, the capital shortage problem, which has been the major handicap, which has crippled our ability to scale these enterprises in the past, is being in part addressed because overseas pots of capital, sovereign wealth, Australian super funds, the Chinese, North American VCs, and that have recognized this arbitrage, the very low valuations of great science-based businesses here in the UK, and are pouring capital into these businesses. So whether it's Google Ventures, or whether it's, as I said, or US VCs, or Asian sovereign wealth, there is a queue, frankly, of highly regarded, deep-pocketed investors who seem to have got this opportunity. And so we find ourselves now investing alongside, much more alongside these sorts of organisations than we do alongside domestic institutional investors.
So how large is the team now, and how many people in the course of a year knock on your door trying to persuade you to invest in them? I have a team of 7 other people helping me make the investment decisions I make. 5 of that team is focused on early stage businesses, quoted and unquoted, and 2 are on the sort of more mature part of the portfolio. So we have a disproportionate asset, if you like, focused on the more labour-intensive exercise of investing in early stage businesses. We're much closer to those businesses. Knowing them and having the relationship that we do with them is as I said, a much more labour-intensive exercise. We have a very close relationship with the businesses that we've backed, and we expect to continue to do that. Of course, when they become public companies, we have to take a step back. And in a lot of cases, actually, we're encouraging our companies to stay private rather than list, because we think they can survive and prosper much better as private businesses than as public. And we think public markets at the moment, or public markets are providing a very hostile environment for some of these businesses, and we would encourage businesses to stay private for much longer as a result of that. I think that will change in time, but at the moment, I think it's certainly the case. I've forgotten your question. So team 7, we spend most of our time really working with the businesses that we've already invested in, and most of our capital that is available is really going to be focused on following on in the businesses that we've already backed. But we do get a regular stream of people who come along with new ideas. And we're very keen to have an open door to those new ideas, even though that we are, at the moment, quite capital constrained. And I saw an amazing business earlier this week. I mean, one of the best presentations I've ever had from any technology-based businesses. It's just based down the road, actually, near us in Harwell. I'd been encouraged to see this business for many months, maybe even years, and I'd never got round to seeing them. We had an amazing meeting with them. It's a very exciting business that's changed. It's delivered every milestone that was ever been put in front of the business, and it's changed a lot in the last 12 months. It was an incredibly exciting meeting, and it just goes to show that, you know, we by no means have, if you like, finished doing what we want to do. There is a constant stream of great businesses and great people
looking for capital.
And finally, let's try and throw our sights forward in the spirit of the long term. Let's take 10 years from now, 2027. What would you like Woodford Patient Capital Trust to have achieved, to be seen to be doing? Would you like it to have stimulated competitors and emulators? Or do you think you're inevitably going to be one of a kind?
My hope is that we would have many emulators. I think it's not that that's my primary job by any means. I have to, I exist and I'm paid to deliver attractive returns to our investors. So the first and foremost goal is for Patient Capital to deliver those returns, which I believe it absolutely will do. I believe it will blow the lights out, actually, in terms of returns to our investors. I'm as confident about that as I've been about anything in my career. That's the number one goal. The sort of second and third goal will be that we help create multi-billion-dollar organisations that become recognised for doing fantastic things and really do change the world, both from that begin to address many of the challenges that the world faces, whether it's climate change or whether it's human disease or all sorts of things. Things like that. I think that would give me a lot of satisfaction if on the way, on that journey, we'd been able to achieve that. And I think finally, the point about attracting other people into this area. If we can demonstrate as a business and with Patient Capital, if we can demonstrate the veracity of our hypothesis that we think we can deliver great returns and there they are, I think we will persuade others to follow us. And I think that can only be good news for the economy.
Ladies and gentlemen, in the spirit of Revolutionaries, may I thank the Lenin of the long term, Neil Woodford CBE. Thank you very much indeed.